In this video, we're going to review Donald Trump's 2020 tax returns, which are his most recently publicly available tax returns. We're going to look at his 1040, his individual tax return, as well as DJT Holdings, which is a partnership that he owns that sends him tens of millions of dollars of losses. We're going to take a look at that one too. But before we get started, I've been creating a lot of tax related political content on Instagram and on TikTok. And sometimes it's a little bit longer than the 60-second shorts that YouTube caps me at. So I don't get to share on YouTube as much as I would like. So I wanted to create a longer form video for my YouTube audience. And I think it actually fits pretty well because these tax returns are quite massive. But we'll narrow it down for you as we go through this. So I'm going to go ahead and share my screen. So here is former President Trump's 2020 individual tax return. So you can see that he had 400K in wages. He had $10.6 million in taxable interest. He had 25,000 in ordinary dividends. He had pensions of 86K. Then here's where it starts to get interesting. And this is what we're going to spend some time looking at on this video. He's got $15.8 million of losses that are flowing through to his 1040, which actually makes his total income negative. So minus 4.7 million, 4.6 million. He has itemized deductions of 915K, and that means that his taxable income is $0. Now, if we scroll to the next page, you'll see that he actually does owe tax right here, and we can take a look at that too to figure out why that is. But he made total estimated payments of $13.6 million. And then it looks like he is getting a credit somewhere of $19,000. So his total payments are 13.7 million. And that means he overpaid by 13.4 million. So he got a $5.4 million refund in 2020 because he took $8 million of his overpayment and he applied it to the 2021 tax return. So if you ever are in a situation where you're getting a large overpayment or large refund from the IRS, you can actually split up how much you receive today versus how much you say, you know what, I'm going to make that an estimated payment for next year's taxes. So Trump in 2020 made $8 million of his refund an estimated payment for future years, and he took $5.4 million in cash as a refund. So let's keep going. Now we're looking at Schedule 1, which is going to tell us a little bit more about how we had that big tax loss that was flowing through the first page of the 1040. So you can see here that we've got $15.6 million coming from rental, real estate, royalties, partnerships, S corporations, trusts, attached Schedule E. We're going to go take a look at Schedule E here in a minute. We also have $501,000 of losses that are just other gains or losses, attached form 4797. So typically that's like selling an interest in something. So we had a loss from that. And then we had $30,000 of business losses. And then we had 382K of refunds from state. So whenever you itemize versus taking the standard deduction, the refunds that you receive from the states become taxable income to you. So that's what that 382K is. And that's because when you itemize deductions, you get to claim a tax deduction for the state taxes that you're paying. So I want to go find Schedule E. But before we get to Schedule E, I want to show you Schedule A because I think it's interesting. So if you look here, the total taxes that he paid, state taxes that he paid, it's income taxes and real estate taxes is $8.5 million. But that SALT limitation caps him at only being able to claim $10,000 of those tax payments. That SALT limitation came into effect with the 2017 Tax Cuts and Jobs Act, which was actually a Trump sponsored legislation. So it's just interesting he has that much, but kneecaps himself essentially. We've got investment interest of 896 as a taxable deduction that he is deducting, and then we have no gifts to charity. So the total itemized deductions here is $915,000. So again, we're just adding this, which I don't know what that is, just some other amount. We've got 896, and then we've got that $10,000 getting to 915. So let's go find Schedule E. All right, we have arrived at Schedule E. Looks like he has some royalties that he has received, 133K of royalties. Not really sure. I guess maybe a book writer fee. So maybe he's did he ghostwrite a book? Well, I don't know why you would have a book writer fee there unless you were like paying for somebody to ghostwrite for you, or maybe an editor or something. But regardless, he earned 133K from writing, and he took $44,000 of expenses. But Schedule E, page 2. So this is Schedule E, page 2. This is where it gets interesting. Now, if you invest in real estate, or if you have partnerships that you are a part of, right? Like Hall CPA is a partnership, so I get a K1 from Hall CPA. It's not on. We don't report it on Schedule C. We report it on Form 1065, and then it flows through to the partners. Where you see that show up in your tax return is on Schedule E, page 2, right? So again, Schedule E, page 2, and it's going to show up right here. You're going to list out all of the partnerships that you're involved with, and then you're going to show their actual income and losses, right? So this is passive loss, passive income, non-passive loss, Section 179 expense, and then non-passive income. Now, when you have as many partnerships as Trump does, or if you just really have more than 4 K1s that you're receiving, then you summarize them on a data table. So it says see additional data table or a statement. So we're going to go find that here in a second, but you always summarize in these boxes. So we can see that all of his partnership activities, he had passive losses of 53 million, passive income of 54 million, non-passive losses of 27 million, non-passive income of 11.7 million. So when you add that all up, you've got a $15.7 million loss, and that loss is what is flowing through to his 1040. So that $15.7 million loss hit Schedule 1, which we just looked at, and then it also flowed through to the 1040. So let's go find these additional data tables and try to figure out what was giving him all of this income and all of these losses. So this is a data table associated with Form 8582. And Form 8582 is the form where you combine passive activities together to figure out how much of a passive loss you can push forward. So this might not be everything on his Schedule E, page 2 that we were just looking at, but I wanted to show you guys this. I think that this is enough for the purposes of this video, because this is the consolidation of all of his holdings, and it's showing the current year net income and net loss, the prior years, and then the overall gain and loss. So let's go down this current year column, and let's just find some interesting things here. You can see on the left-hand side that he has a ton of holdings, right? I mean, he's involved in a lot of stuff, which is not totally uncommon for real estate investors. So that's not like alarming by any means the imagination. But here we've got $4.3 million of income, $1.4 million of income. We've got a nice loss there. We have a $3 million loss, a $2 million loss. We have a $2.5 million loss between these two. 2.5 million, $1.3 million loss, $2.7 million loss right here. And here's a big one, $22.8 million tax loss coming from DJT Holdings, which is what we're about to review here in a second. So we'll take a look at that one. $1.6 million loss, 800K, 800K, $4 million loss, another DJT Holdings, $9 million loss. So, I mean, pretty significant losses coming from these various real estate partnerships. And looking at the 1040 in and of itself isn't going to tell you much, right? So we have to go and actually pull up these partnership tax returns. We do have DJT Holdings tax returns that those were publicly released, at least for 2020. So let's go take a look at those now. Okay, now we're looking at DJT Holdings LLC. This is a partnership tax return because we're filing a Form 1065. And this is for the 2020 tax year. So we know we're in the right place. Okay, so DJT Holdings had $18 million of income, $10.9 million of COGS, cost of goods sold, like inventory, $8 million of gross profit. They also had a $48 million loss from other partnerships, estates, and trusts. So this is where we get into the layering that the ultra high net worth, ultra wealthy people do. They'll have a partnership stacked on top of a partnership, stacked on top of a partnership, stacked on top of a partnership. And I mean, these can go hundreds of layers deep. They can include corporations, they can include trusts, could be onshore, could be offshore. And so whenever you see anything about the IRS auditing large partnerships or trying to audit wealthy people, but really struggling to do that, This is why, because there's layer after layer after layer. And when you go through the auditing process, you have all these partnership audit rules where you might have to include all the partners, you might not have to include all the partners, you have to contact them and not contact. It gets really messy really fast. So we have $48 million coming from other partnerships, other investment stakes that DJT Holdings has taken an investment in. And so we'll take a look at that statement too and see if we have access to those returns. And if we do, surprise bonus for this video, we'll go through those as well. But let's keep going. So we've got total income or loss when you combine everything, $40 million tax loss or $40 million operating loss. Then we have all of the expenses. We haven't even gotten to the expenses yet, right? We're already minus 40, but then we have all the expenses. And so total deductions are 19 million. So when you add minus 40 minus 19, you get minus 59. So a $59 million tax loss coming from DJT Holdings LLC. Okay, so this is the balance sheet for DJT Holdings. If you want to pause and look at everything, you're more than welcome to. But you can see the beginning of 2020 and then the end of 2020. So it's always the beginning of the year and then end of the year. But at the end of 2020, they had $2.3 million in cash, $1.1 million in inventories, about $4.7 million of other current assets. Not really sure what that would be. $446 million of other investments. So you can see DJT Holdings is where he accumulates I'm going to just, make a general statement in terms of what we see our clients do, which is kind of similar. You have an operating company, a holding company, if you will, that kind of accumulates everything and makes all the investments. And it kind of looks like that's what's happening here. So we've got $446 million of investments that DJT Holdings holds. And that's probably also where we're getting that like $48 million tax loss that's coming from those other partnerships. So hopefully we'll see that here in a second. We've got $9.3 million of buildings, 16 million of land, and $96 million of other assets. Not really sure what that would be, but there is a statement attached. So we have $577 million of total assets. And the way that we get to 577 is partner capital account of 514 million, liabilities of only 55 million. So kind of interesting. That means that we've contributed a ton of cash. And the reason that I say that's interesting is this is a pretty significant amount of cash that the partners of DJT Holdings have contributed to DJT Holdings to fund its operations. So anytime you see partner capital accounts, that's essentially what that means. It's like if you and I were partnering together and I put in 50K and you put in 50K, our cash balance would be $100,000 and our partner capital account would be $100,000 because it's accounting for the cash that you and I have put in. So essentially, the partners of DJT Holdings have put in $514 million. Now, that doesn't necessarily mean that they contributed $514 million. It could have been that they just never made distributions out of DJT Holdings. They let its cash balance stack, and there's a lot of things that could have led to $514 million. And also, it doesn't necessarily stop Donald Trump or the other partners from taking a loan and then contributing the loan proceeds to DJT Holdings, right? So again, going back to that example of me and you partnering together, if you put in 50K of cold hard cash and I took a HELOC of 50K and then put 50K in, it's still going to show $100,000 of partner capital account, but I got mine via debt. Okay, so it's not really the full picture, but it's just kind of interesting to look at nonetheless. But let's keep going. Okay, I believe that I found the data table that shows that $48 million loss that we saw on the first page of the tax returns. So you can see the income or loss per tax return amount that is allocable to DJT Holdings. And if we go down this list, we've got multi-million dollar tax loss, multi-million dollar income. Here we go. This is a big one. $8 million from Trump Endeavor 12 LLC. I'll have to check. I don't know if we have that return. We have a $23 million tax loss from the Trump Old Post Office LLC. That would be an interesting one to take a look at. We have a $9.6 million from Turnberry Scotland LLC. And I don't know what these LLCs are. I don't know what their holdings are. $4.2 million from TW Venture LLC. I mean, I presume that these are all real estate losses from like depreciation and bonus depreciation. I would assume that, but I don't know. I don't know if we have these returns. 1.5 million. We've got 2.5 million from the International Golf Club. That has to be depreciation. The hotel's management, $3.2 million tax loss. That also has to be depreciation. And that's it. So I mean, again, the significance of the holdings is one thing, but also remember these are all layered, right? So DJT Holdings is a layer, and then everything here that you're seeing is the next layer. So it's Trump, DJT Holdings, and then everything else that you're seeing. And who knows what these guys are all investing in too. Again, I don't know that we have all these tax returns, but a pretty interesting look at all of the holdings that he has and how these are all performing. And again, the big tax losses, big tax losses don't necessarily mean that they actually lost money. They didn't necessarily have a net operating loss. It really just depends on that depreciation expense, right? So a lot of times real estate investors will depreciate their rental property, rental being a single family home, multifamily, commercial property, a hotel, a post office, right? Triple net lease. That's all rental property too. So we can depreciate the property, and we essentially it's an expense that we get to claim on our tax returns without having to come out of pocket for it. So it's just a calculation. We bought the property for $10 million. $10 million divided by 39 years is my annual depreciation expense. It doesn't matter if I 100% financed my $10 million purchase, if I paid 100% cash, if I went 30-70, 50-50, 70-30, doesn't matter, right? The depreciation calculation is the same. It's $10 million divided by 39 years. Sorry, let me back up. 10 million less the cost of land divided by 39 years for non-residential property. So it's just a calculation to come up with that annual depreciation expense. But there's also bonus depreciation. In 2024, you can bonus depreciate 60% of any component with useful life of less than 20 years. So what real estate investors do is they'll buy property. They will get a cost segregation study performed. And a cost segregation study is the practice of identifying those components with a useful life of less than 20 years. So they'll go into a property. These people that do the study will go into your property and they'll walk it and they'll look around and they say, it's true that the entire building will appreciate in value. But it's also true that all these components fall apart. And this 39-year schedule is meant to track that falling apart. However, there are also components inside of this building that are not going to last 39 years, right? So we're going to identify those components. So that's what the cost seg people do. They walk through the building and they figure out what components inside of that $10 million purchase are not actually going to last 39 years. And so after a cost segregation study is done, you end up with a data table of 5-year property, 7-year property, 15-year property, and also 39-year property. So they basically extract value out of this 39-year bucket and they put it into 5, 7, and 15-year buckets. But now with bonus depreciation being 60% of any component of the useful life of less than 20 years, that means we can immediately expense the cost of 5, 7, and 15-year property. Now, back in 2020, when Trump was doing this, bonus depreciation was 100%. And the way that it kind of works, just rough numbers, if you buy a $10 million commercial property and you do this cost seg study, you could generally allocate 20 to 30% of the purchase price to components with 5, 7, 15-year property. And if you kind of think about it, that means that on a $10 million purchase, we're talking about $2 to $3 million allocated to 5, 7, 15-year property. But with 100% bonus depreciation back in 2020, that gives us an immediate $2 to $3 million tax loss, or at least deduction that we can write off against the income that property generates. And in the first year of ownership will typically translate to a large tax loss. I suspect that's what's going on here, and here. But I don't know for sure. Let's see what tax returns we actually have. All right, I'm on Tax Notes. Tax Notes is an awesome website. Highly recommend that you check it out. But they have the presidential tax returns, as you can see. And then we've got Donald Trump here. We've got 34 tax returns. And it looks like we have DJT Holdings managing member, DTTM operations, LFB acquisition. All right, let's go back to the return and see if we've got any of these. So if we're back on the return and we're looking at the ones that created the big losses, Trump Endeavor, Trump Old Post Office, Turnberry, and TW Venture. So not that exciting. Unfortunately, we don't have access to those returns. So we can't really see if that was depreciation or not. But Tax Notes does have this return. I mean, I'm not going to go into that. $1.4 million of income is not that exciting, which I know sounds bonkers to say, but yeah, there's one more thing that I want to show you, and that is Form 8825. 8825 is where we report rental real estate for partnership activities or for S corporations. So here we've got at least 4 properties. Not really sure what these are because they don't they blurred out the addresses, but you can see we got gross rents right here. We've got all of the expenses. We have depreciation. That's line 14. So you can see those numbers there. And then we've got the net income per property right here. So you can see that these properties produced a large tax loss, though interestingly, not really from depreciation. I mean, we have a total $2.4 million loss, and this is coming from something else. But look at the depreciation. I mean, it's 183 plus 56 plus 13 plus 139. I mean, that's roughly what, $400,000 of depreciation expense. So the way that you can kind of figure net operating income is you look at this total loss and you subtract out the depreciation expense. So we still have like a total net operating loss of $2,050,000 roughly, maybe a little bit more than that. So kind of interesting. That means that these properties are actually producing real tax losses, meaning that $2 million is actually leaving our pocket. Normally, what you would see with real estate investors is you would see this big $2 million tax loss, but the depreciation numbers would be like $2 million. So when you back out the $2 million, all of a sudden it's either not as big of a loss or it's actually positive income, net operating income at the end of the day. Well, that's all I've got for you. Thanks for sitting through this kind of new thing for me to do and put out there on YouTube. But if you found this helpful, subscribe to my channel. That will really help me. Feel free to ask questions. I'll happily engage with you on this video. And then check out my TikTok and my Instagram. TikTok and Instagram, but still, like, I'm trying to grow following there and put out some helpful content there too, and would love to see you on those platforms. Thanks so much again for watching.